Most people get too distracted by the narrative of the day. There's going to be AI tokens and AI agents. There's going to be decentralized finance and requests by the government to purchase more crypto to relax regulations. That's why prices should go up over time. That's why we should make money. I don't think that's true. Really, when it boils down to it, it's all just about demand versus supply. For us to make money, we have to have more buyers than sellers. And so the easiest way to go about this topic is just to ask, who is buying, who is selling, and what are the driving forces behind both of those? In an ideal world, we see continued accumulation through Wall Street. This here is the balance of the number of Bitcoin held by the Bitcoin ETFs. So that long-term trend looks good. Add on top of that the Bitcoin treasury companies led by Michael Saylor's strategy, but even without Michael Saylor, we do see accumulation. So there are two sources of relatively constant demand that should support prices long term. But what about the medium term? Ideally, we don't just want to have the demand, we also want the supply to stay rather limited. High demand, low supply. Now there's of course the Bitcoin mining, which is a predictable inflation rate of 0.85% per annum right now. But really the driving force is the long-term holders. Are they currently selling or are they not selling? And the value days destroyed multiple is high. That means a lot of the dormant Bitcoin that hasn't moved for a long time suddenly gets reactivated. So it's the long-term holders that take profit during a bull run. And we want this to be low for the price to potentially go up. Luckily, this is currently quite low. So there are the long-term sources of demand, right? The treasury companies and Wall Street, and potentially the long-term holders that still continue to dollar cost average into Bitcoin. But then there's also short-term demand that can turn into supply. So I'm talking about the tourists, the people that get excited about a rising Bitcoin price that then ask when we hit a new all-time high, should I now buy Bitcoin? Now to a degree this is good, it accelerates the bull market a bit further, we can sell for even higher prices, but on the flip side it also means that those people, they get burned at some point, right? When the long-term holders then sell into the rally, then the tourists, they give up, they sell afterwards, and that all increases the volatility of the market. What you're seeing over here, that's the realized HODL ratio. So the trading activity of the long-term holders, how much are they transacting Bitcoin versus the short-term holders, how quickly are they transacting? If a lot of short-term holders are currently transacting Bitcoin, then the market is heated and that short-term demand might turn into supply. That then leads of course to falling prices. So have a look at how nicely this oscillates over time. When the realized HODL ratio is very high, there's a lot of short-term speculation and we want to rather sell. When there's no short-term speculation and it's only the long-term holders that dollar cost average into Bitcoin, that's when we want to buy. And this gives us a first insight of where we currently are. Unfortunately, even though there are not a lot of new people entering the space, there's still enough short-term holder activity that we can't really say that the market is quote-unquote dead, that it's completely silent, that only long-term holders are buying and now's the perfect time to get in as well. Unfortunately, we are not there. We are rather balanced and the market seems to be cooling. Even though the price is still going up, it seems to be cooling. The lower we are, of course, the better it is to buy for the long term. Another source of potential supply is of course profit taking. And there's only profit to be taken when people are actually in unrealized profit. As in, if you bought lower, now the price is higher, you might consider to sell because you've got unrealized profit, but you might only do so until you've reached a certain threshold. What we see here is the net unrealized profit and loss. When this is very high, then there's a chance people realize those gains and then the market goes down. If then the market on average is in losses, there's not so much more profit taking. There is no profit on average to be taken. And so people just wait it out until the bear market is over, until people are in profit again. They wait for the long-term holders to continue buying. Or nowadays, it's maybe rather the ETFs and the treasury companies. They that might form the next bottom. Especially the ETFs, because the treasury companies, they are forced to buy when we are at new all-time highs. That has something to do with the way how their solvency is measured, right? They use Bitcoin as collateral to buy more Bitcoin. When that collateral falls in value, they've got a hard time accumulating more Bitcoin because they can't lever this up much more. That's why we see that little purchases through the treasury companies in the bear market, and we see much more purchases after Bitcoin has hit an all-time high. It's not that Michael Saylor is that bad of a market timer. It's simply that he doesn't have the ability to buy at low prices because the collateral for his debt isn't worth much. By the way, if you're getting value out of this video, then feel free to subscribe. This might be the easiest ROI you might be making today. And so that's the bad story right now, right? There are still net unrealized gains. The average cost basis of the market is currently $56,000. We are above that, and so people might take some profit with every market rally. If we look at the long-term holder realized price, that's even lower. That's currently at $39,000. I'm not saying that we're going to revisit this anytime soon. I'm simply saying that any trade that we currently make is a momentum trade. We need to have some kind of a risk mitigation strategy as well. If you're not willing to hold Bitcoin all the way down to 39K, then any investment you're currently making should rather be short-term in nature. It should be momentum plays. It should not be declared as a value play if currently the value of Bitcoin isn't really that great. If you currently think Bitcoin is cheap and it's a value play, you should find it even cheaper when it's at 39K. You should be buying even more when it's at 39K and not then panic sell. And so that's where the market is split. Some people say just wait it out, just dollar cost average in and buy even more if we are low. Others try to time the market. I am of the second camp. I have been able to time the market pretty well throughout the cycles. And while you can simply just set and forget and dollar cost average in and get at least the 6.8% per annum, right? That's how much the US dollar devalues over time. This is the monetary base in the US, USM2. It grows by 6.8%. So Bitcoin will at least grow at that rate, probably quicker than that. You have to be okay with top to bottom bear markets of more than 70%, right? This was our last bear market, minus 76%. If you're not okay in principle to ride through bear markets like this, then any purchase you currently make needs to have some kind of a risk management strategy behind it. There needs to be a way to potentially then flip and say, okay, the current bullish momentum does not continue. I exit and I hope to then buy back in again when we are at the end of a bear market. I've talked about my personal approach time and time again on this channel, right? I use the 44-day simple moving average in Bitcoin. I've backtested all moving averages of Bitcoin all the way to the 200-day. The 44-day works the best, so I buy whenever we are above, I sell whenever we are below, and I, at least historically with the backtest, outperform buying and holding Bitcoin massively with that. We've also got this now in a copy trading pool where this trading is automated that already has now made 10% return, while Bitcoin during the same time period actually lost 22%. So I've already got more than 30% of alpha in the span of just 3 months following some market timing. But that's the idea here, right? We just cut our losses. If we suddenly fall below that moving average, so it's just below 90,000 US dollars per Bitcoin, we would flip bearish. We would go in capital preservation mode again. We will then bet on falling prices. It's a very different time horizon compared to the macro cycles. Both are viable strategies. It's just a different way to deal with the risk. If you're okay to ride through those bear markets, if you're okay to potentially see the long-term holder cost basis again, which we have seen at the end of the bear market time and time again, right? After Mt. Gox, after the ICO bubble, during COVID, after FTX. When something systemic implodes, then we can go to those kinds of levels. If you're okay with that potential risk, then by all means do not try to time the market. But if you're not okay with that potential risk, you have to find some kind of risk mitigation strategy. This moving average is just my preferred approach, but there's many approaches. Use whatever you find is most suitable for you. If you want to get, however, into this strategy without manually doing all the trades, then you can check out the premium membership. It's currently $125 per month. There's also a $250 discount if you decide to enter for the yearly membership. As usual, thanks again for watching. See you next time in YouTube, or potentially see you in premium as well. See you next time. Cheers.